Hi everyone, good morning. Thanks a lot for joining this webinar. I think this is uh, the fifth, sixth webinar that we're doing since we started doing these webinars regularly, I think since last year. So thanks a lot for joining. And we are we are in a quite a situation right now in terms of the geopolitical context, the economic context, and how some of these currencies are moving, right? So we thought it's very important for us to share whatever we are thinking in terms of our what we believe can shape the market going forward. Right now, the standard disclaimer is that whatever we discuss on this in this next 1 hour or so is not investment advice. It is not meant for you to go and buy or sell some of these whatever we discuss, whatever recommendations, whatever I end up saying, it's not a buy sell recommendation. So please do not act on this. And even if you act on this, then please separately check with your advisor for people who are not already our clients. Right. So with that, let me just begin with the session. Quickly, as always, we try and cover our performance. So we started this business in 2022 after I left my investment banking job. These are the two themes that we've done, Technofunda and venture capital investors portfolio. Technofunda is meant to be a sector rotation sort of strategy, whereas venture capital investors is meant to be a buy in early, stay the course, sort of invest in multi-baggers, right? That sort of theme where we mostly buy and hold, whereas Technofunda is meant to have a little bit of churn every 3 to 4 years as the cycle sort of goes through ups and downs, right? So more or less we've done close to on an average 40% over the last 3.5 years. Now, quickly coming to the discussion points for today, and a lot of this connects to what we have discussed over the last 4 or 5 sessions. So it's like a flow, right? So, um, for example, we will not be discussing China this time. We will not be discussing precious metals this time, as in I have not prepared anything on it. So the view that we had on precious metals and China that we discussed last time continues to be, right? So there's no change there. Otherwise, we would have included, if there was a change, then we would have included it in this time's presentation. So there is no change in our view as far as precious metals are concerned, as far as our thesis on China is concerned, as far as our view on US markets are concerned. Majority of that continues to say, and we have, as far as we are concerned, we have not made any changes to our understanding or our thesis, right? So what we are going to discuss in this session is mostly going to be around, what happened in Indian markets in the Q2 results, Q3 results that we saw. So we'll discuss very briefly the Q3 results season. Also, we had a lot of, incentives being monetary and fiscal incentives. Both RBI and the government of India has done a lot to sort of, push the Indian economy, make sure that we, come back on the growth path. So are we sort of recovering is what we've tried to discuss, and what's been the impact we also had between the last time and this time. We also had two big trade deals, right? The both the mother and the father of the deals, which is the India EU deal and the India US deal, right? So-called mother and father deals. So we'll discuss that slightly. What impact will it have on Indian markets? Also, we've been getting a lot of questions on IT services. What's our view on IT and how AI will impact IT? And the last is about how liquidity is moving in the system, right? Because no matter what the valuations are and no matter what the earnings are, the biggest driver of markets are liquidity, right? So unless we understand liquidity, it's very difficult to take a bullish or a bearish view of the markets. So Starting with the Q3 results season, the street view is that, and mostly our view as well, is that Q3 was slightly better. So we are recovering because if you look at the quarter-on-quarter numbers here, we started seeing some degrowth in Q4 FY25, Q1 FY26, and Q2 FY26 was really low at 2% year-on-year growth, whereas we've come back to now Q3 is slightly better versus Q2. So we are now currently doing 8%. So you can say that, GST rate cuts, all that had some impact on the earnings season. We had a mixed bag in terms of the sectors that did well and did not do well. For example, consumer discretionary and consumer discretionary really did well, right? As well as energies did well. So these are the two. The ones that did not do well were technology was sort of a laggard, real estate sort of cooled down a bit, uh, right? So these were some sectors which, from a sector point of view, it was a mixed bag. Uh, and a lot of brokerages who are watching quarterly results and different sectors and all that, they have a slightly bullish view. I wouldn't say very bullish view, but they have a slightly more bullish view, which is to say that, now the slowdown has sort of bottomed out. From here on, we will start to see some kind of growth. Of course, some sectors, for example, IT, real estate, infra, these are sectors which continue to stay under pressure, whereas consumer discretionary, banking, energy, healthcare, uh, and after the trade deals, especially in the industrials and manufacturing, chemical also as part of industrials and manufacturing. Some of these sectors are starting to look good, right? Now, uh, when I say these are starting to look good, doesn't mean that there will be a bull run in these sectors, right? So when I all that we mean to say is that the correction has sort of stabilized. Earnings growth will now start to kick in slowly and gradually. It's not going to be a bumper sort of incremental increase in earnings or any surprise type of growth in earnings. There will be a small incremental growth of earnings because these sectors, especially chemical and all, have not done really well over the last 4 or 5 years, right? So you will see some growth, but it's not going to be huge growth. And hence, broadly speaking, we might start to do incrementally well from here onwards, right? As far as the quarterly performance and the numbers are concerned. So it's been a mixed bag, nothing exceptional or great about it. But yes, it is definitely a gradual improvement over the last 3, 4 years. Of course, there is sector rotation happening as we speak right now, right? So, for example, consumer discretionary, banking, finance, auto especially has done really well. So you will at this juncture see a lot of rebalancing happening between these sectors. I mean, this is a very ideal sector, very ideal time to be doing rebalancing. Shifting between sectors depending upon which sector is peaking and which sector is bottoming out. And all of this that I'm presenting to you is basically what the numbers are. Um, we have a slightly different view of the markets. As you all know, we are not invested in stocks right now. We have completely exited, and we are not trying to time any of these sectors at this point of time. Uh, you know, as we've covered in the last sessions as well, because we believe there is a much bigger issue, not in India, but outside of India, and that trigger can uh, escalate quickly in a very short period of time, and the drawdown could be very, very significant to the tune of 25, 30%, maybe 40% as well. And hence we are sort of staying out. But to give you some perspective, the economy, Indian economy per se, uh, is starting to do well. One couple of more recovery signs here is that the credit growth has really started picking up. We had some improvement in December. Jan has been even better. So we starting to see that credit growth cycle where bank credit growth, banks are lending higher capital. Although the issue has been that deposit growth rate continues to lag credit growth rate, right? So that remains an issue, which is why it's sometimes expected of RBI to put in liquidity measures so that at least banks stay liquidated and they have enough capital to lend as and when the time comes, right? And all of these has been because of whatever steps, both monetary and fiscal steps that both the RBI and the government of India has taken over the last whatever 1 year, right? So we had GST rationalization, we had rate cuts, and we had rise of wholesale credit demand. Right? Now, what one thing which hasn't picked up because if you look at the gross capital formation, gross capex, right, which is a combination of government capex as well as private capex. So the government has really done its part, but private capex has not picked up. So that remains a segment where we've not seen enough capex happening, and there's a lot of room in that space to grow. So, and I think the real firepower of Indian economy will start to show when we see private capex happening at a very aggressive pace, which honestly post-COVID has died down. I mean, it's a very low number. Of course, it's happening in parts and pieces, but the broader capex number remains flat or timid, right? And uh, a lot of economists, rightly so, point out that as long as we don't see private capex growth really increasing quarter on quarter, it is very difficult to start uh, tangible sort of movement in the economy. And it also relates to FII flows, right? So if the economy is not that great and the earnings growth is not that great, so most likely we'll also not see a lot of FII capital pouring in. And I think a couple of roadblockers why capex growth was not happening, especially uncertainty around these trade deals, which is now ended. So in a way, we can expect some of these with some sort of policy certainty now we can expect some capex to start picking up. Now let's briefly touch upon what has been discussed, the India EU and the India US trade deals. Now, very recent news yesterday, the Supreme Court in US they have struck down uh, the tariff thing, saying that the president is not allowed to do so, and hence it is unconstitutional. And as a result of which, they have brought down the tariffs to 10% from 18%. So we're at 15%. Now, a couple of weeks back when we did the trade deal, we came back to 18%, and now we are at 10%. But relatively speaking, now we don't have that advantage because we were 18 and the other nations were around just 19 to 20, 25%, but now everybody is 10%, right? So that brings all of us on the same benchmark, relatively speaking. And whoever is now the lowest cost producer sort of gets to sell in US at the lowest price. So, so, so in a way, I don't think it's relatively speaking, it's not in our positive because at 18% we were relatively better placed. At 10% for the whole world, we are almost as same as, for example, textiles sector between India and Bangladesh. They will also be charged at 10%. We'll also be charged at 10%. Now, since Bangladesh is slightly cheaper, so they might excel, right? So most likely not a big deal. I mean, it's not that we went from 18% to 10%. So markets are going to go up. In fact, we'll talk about how markets behaved when the US trade deal happened. But this is sort of a neutral thing, not expecting a huge, great movement because of this, right? So, but definitely these two trade deals will, going forward. They will promote, as in they will encourage some sectors to do well, especially the high labor industries like textiles, auto ancillaries, engineering exports, chemicals, specialty chemicals. These industries will definitely do well. We will end up exporting, textiles, chemicals, engineering exports, auto ancillaries, both to US and EU over the next, I think, 2 decades or so. That those export numbers will keep growing. Uh, so and there is a chance that the capex cycle might now start moving up. As we discussed, that it's not been doing great for the last couple of years. Now we will start to see the private capex sort of going up. Uh, from a rupee point of view, this is definitely good because stronger exports will lead to better current account deficit. Better current account deficits will lead to stable rupee, and that will sort of encourage more FIIs to invest in India. So one would expect that, with the EU and the US trade deal, FIIs would start coming back to India, right? Which we will see whether it happened or not. Okay, so let me just move there directly. So if you look at the capital flow situation, right, one knows that till January it was negative, immensely negative. FIs have been selling all the way from September 2024 to January, and one would have expected that in Feb the FI selling would have stopped, and we would have seen some money coming into the Indian markets. But as we see right now, 20th Feb overall, from 1st Feb to 20th Feb, we've seen a overall FI selling of 2,000 odd crores. There was some incremental buying, but 13th Feb single day there was 7,400 crores of selling, which of course has been absorbed by the domestic investor. Right now, the concern here is that for the last 1.5 years, FIIs have been selling. Domestic investors have been sort of very patiently buying every correction, every selling. They've been the ones who've been absorbing all of this, right? And Indian markets continue to stay at 25, 26,000 level, which is very close to the previous all-time high. Now, the biggest risk here is that, a lot of domestic investors who've started investing in India for the first time since 2024 have actually not made any money, right? So on their mutual fund investments or in their personal equity portfolios, they might just be seeing negative returns over the last 1.5 years. It's very possible that 8 out of 10 people might have that kind of portfolio because that's what the broad market is saying. Now, we might see some sort of that we might see the bull investors getting tired with what is happening in the markets because it's not just picking up. And it may so happen that if these investors get tired and they start questioning ki we could have invested in, for example, FDs. 2 साल invest FD में किया रहता तो whatever 10-11% बनता post tax, right? So these things start coming in their mind, and that sort of what we've already seen is that the SIP movement that was happening very strongly till Jan, a lot of that SIP has now slowing down. So imagine a situation where FI investors भी बेच रहे हैं और DI investors भी बेच रहे हैं. And that is what me as a portfolio manager, when we think of that situation, we are not very bullish of the market. Uh, Especially from a capital flow point of view, because capital flow is not favorable, liquidity is not favorable. Whatever strength that we've seen in the market is all because of DIIs, buying at all levels, every correction. But at some point of time, I'm saying they'll get tired of it because if they don't see returns for 1.5, 2.5, 3 years, so they'll get tired of it and they'll also move their capital to places where they actually make some money. So that risk remains. How long will FII stay out of Indian markets, and this how long this selling will continue also depends on what is happening in US, which is where we have a very bearish view. and we believe the FII selling will continue for at least the next 6 to 7 months. You know, uh, till at least US, markets in US come down to a relatively benign valuation. As we know, AI bubble is real. AI stocks trade at excessive, exaggerated valuations. So unless we see some of that correction, plus the long-term yields in US, the debt market that in US is slightly under stress because of multiple issues. The stress there comes down. We might see more and more demand for the dollar versus the rupee, and this capital pulling might continue. So I'll come back to that, but great deals, I mean, good for us. A lot of these sectors will start doing well. Of course, if you start looking sector by sector, auto sector might be at a disadvantage because, Indian automakers had really started launching very good models at, 15 lakh plus, 20 lakh plus, that sort of budget. But now that it is easier and, slightly significantly less expensive to import in Mercedes and BMWs and Audis. We might see a lot of these cars on Indian roads over the next 4 or 5 years, and there might be a stress for the automakers, Mahindra and Mahindra, Tata Motors, and Hyundai, when it comes to selling cars which are 15 lakhs plus in terms of the categorization. So 15 lakhs plus, there might just be a more demand for European made cars versus Indian cars, and that's where Indian automakers might be at a disadvantage, right? But for people like my Maruti Suzuki and all, it will remain business as usual because the majority of their sales happens in the 10-15 lakh category. So sector by sector, I think we'll have to look at. But yes, textiles, chemicals, auto ancillaries, engineering, some sort of a couple of manufacturing sectors, they will definitely get benefited. Uh, a lot of labor heavy industries will see doing well. Now let's come to IT services. This is a much asked question. Now, as you all know, a lot of investors know we've not taken any exposure to any IT stock since I started this business in 2022. We've not bought a single IT company. At that point of time, valuation was very high. Now valuations have corrected. I would say they are close to the mean or slightly below the mean. TCS used to trade at 45 times price to earnings. Now I think it's somewhere close to between 20 to 25. That's where it is. With the recent correction, it might have come down, below 20. But as expected, the mean reversion has happened. But as we stand today, there's a lot of AI disruption. Now, what will happen is that this will eventually move from, so in IT, people are the raw material, right? So the more number of people you hire and then you do dollar billing for every hour, that's how your revenue grows. Now that model will go for a toss. Most likely, or some of these models will now become fixed price contracts instead of hourly contracts because they know how much they want to spend. They know it can be done for less. So IT companies will be given a mandate, you do this project for this and this cost, like how it used to happen in India. And IT companies used to complain that Indian clients are not paying as much as the US clients. So everybody wants to do business in US and Europe. I somehow believe that a lot of Indian IT companies will actually now start taking up Indian clients also. So we will see a lot of business coming from India, and IT companies actively, proactively pitching for IT business in India because in my view, a lot of these contracts will become fixed price contracts. It will not be, and the services company at their end will then be forced to optimize margins. They will have to reduce the headcount so that they can have create the same margins, uh, as they used to do earlier with a lesser headcount, of course. So they will fire or hire less. And of course, AI will enable all of that productivity improvement. So whatever 10 people were doing, 2 people might just be able to do that. So I think there'll be a fundamental shift of how this business model used to work. we will see a shift from dollar per hour billing, dollar per person per dollar per hour dollar billing to something like a fixed price contract, and hence fundamental shift in how the revenue realization happens, how some of these contracts, the budgeting of these contracts happens, uh, and just like how it happened with brokerage industry, that brokerage industry moved from being full service brokers to discount brokers. So we had a new set of players like Zerodha, Angel One, Grow, all of these people come. Now, Angel One at that point of time was very unique because Angel One had a complete physical presence, and they moved to complete online presence. And Angel One has been one of our investments yeah, earlier, and it's not a recommendation right now, but that business model went through 4 or 5 years of transformation, and that 4 or 5 years were really bad for them. So very few businesses actually honestly can on listed businesses that too can digest a 4 or 5 year of transformation, because in those 4 or 5 years you go through a revenue drop, your margins correct, you have to invest a lot in new technologies, right? And the stock markets really punish you for doing that. But nonetheless, that's an important part of growing up. So Angel One did that, and during the transformation phase, their valuation came down. The stock took a beating. Something very similar has to now happen in the IT industry, where these guys have to really work on how they want to design the business model, how many people required, what sort of efficiency to be built into the system, and that will take 4 or 5 years. So it's a reset phase. It will go through some sort of correction before bottoming out, and then maybe in 4 or 5 years' time, the cycle might turn. But I'm saying at least for the next 1 to 2 years, we have a very bearish view on IT. We don't think a correction has to be bought in. So there is no hurry to buy IT stocks even at 15 times price to earnings, because we believe that this whole transition might just take more time than one would assume. So the capital flow thing now, I also want to talk about Nifty 50, right? The index itself, and I'll switch between the PPT and the trading view. So we don't have a trading view. So anyway, so I have the screenshot. So if you look at Nifty 50 over the last 5 6 years, I put a 5 year return here, and which sector sort of did contribute how much to the Nifty 50 over the last 5 years. So you will basically find three sectors: banking and financials. I will take up questions after I finish. I think couple of more slides, one or two more slides, and then I'll take the questions. So banking and financials, automobiles, and capital goods industrials, these are the three sort of sectors which have really done well, and which have really contributed to Nifty 50 reaching at 26,000 levels over the last 4 or 5 years post-COVID. And especially within these three, the banking and the automobile sector continue to do well. So this might have just slowed down, but automobiles, as we speak right now, that particular index is at all-time high. Banking and financials, and within banking and financials, especially PSUs and NBFCs have done really well over the last 1 2 years. PSU banks have got uh, re-rated. So they used to trade at 0.5, 0.6 times price to book, and now, for example, Bank of Baroda trades at 1.1 and SBI trades at almost 2 times price to books. So of course they have seen a lot of, if you look at the price is a multiple of price to earnings as well as the EPS growth. So banking sector, especially PSU banks, have seen both EPS growth, significant EPS growth, as well as the re-rating also. The price to earnings have also re-rated. So that's been the reason for the rise. Uh, that also applies to the automobile sector. So huge re-rating of that sector, Also, the fact that EPS growth has happened in that sector. Now, एक कहावत है बेसिकली कि हर बुल रन का घोड़ा अलग होता है, राइट? सो पिछले 5 साल से जो बुल रन आया है इंडियन मार्केट्स में, उसका उसके दो तीन घोड़े हैं जो आपको दिख रहा है. बैंकिंग फाइनेंशियल इज वन हॉर्स, द ड्राइवर ऑफ द sort of rally, and automobiles, of course, the driver of the rally. Now, why I'm discussing this is we might just be seeing the top of these rallies as we speak right now. The What I want to convey here is that we are not too far away from the peaks of these two sectors. They have done well over the last 4 5 years, and they might have just peaked. And I'll tell you why. But तो क्या होता है कि जब वो घोड़ा स्लो हो जाता है तो जो रैली है उसमें भी स्लो डाउन आ जाता है. And then a new set of horses have to then pick the baton and ride the market from there on. So till we figure out who are the new set of sectors, which is why I was also saying that this is a good time to do sector rebalancing, right? So the thing is, our assessment is that we will see some sort of slowdown in both BFSI and automobile sectors. uh, if today is not the peak, what we are saying is the peak is not too far away. Now, let me tell you why. So, if you look at this slide here, what I've done is I've put Nifty Auto. Nifty Auto, over the last 3 years, the price to earnings ratio of this sector came all the way down to 30, and I'm talking broadly Nifty Auto. And then from there on, the PE rating has happened significantly. It's gone back again up to 32, 33 times price to earnings. Now, 33 times price to earnings for the auto sector is relatively high, right? So if we start to see some sort of mean reversion, because the last time mean reversion started happening was from the same levels. So if Nifty Auto starts to slow down from these levels because of mean reversion, that will impact Nifty 50. Nifty 50 will again start slowing down. ठीक है, दो तीन बड़े बड़े सेक्टर अगर आपके जो जो कंट्रीब्यूट करते हैं वो अगर स्लो होने लगे तो ब्रॉडर निफ्टी 50 will also slow down. And it's not like real estate is doing. Real estate also has slowed down. Infra has also slowed down. If you look at the oil and gas sector last year delivered peak profitability. Now with cheap Russian oil going away, uh, my assessment is we are not going to see those peak profitability numbers anytime soon. So again, the oil and gas sector is not a gate, is not like driving Nifty. IT sector is not going to drive Nifty. So what is going to drive Nifty? Whatever did push Nifty upwards is now starting to slow down, or there are high chances that some sort of mean reversion can start happening from these levels. If not today, tomorrow, maybe another 2 3 months. Right, so one has to be very cautious at these levels because there might just be some sort of slowdown, especially in these two sectors. And as you sort of, we'll anyways keep you informed, but it's very important to track these two sectors from a Nifty point of view, broader market point. So I've done Nifty 50. Nifty 50 already seems like it's way too, uh, way too up as far as the mean is concerned. The mean is somewhere close to 25x, and we are at 33. Right? So we can expect mean reversion from here. The banking sector, and especially when I say banking, we've seen a lot of BFSI stocks do well. Sorry, we have seen a lot of NBFC stocks do well post the microfinance crash that we saw. We really saw microfinance NBFCs really do well, and of course PSU banks have been doing well for the last 1.5 2 years. At some point of time, we were also invested, but we exited. Um, but as we stand today, the average price to book, for example, SBI is 1.4. We are at 2. The peak is at 2. The 10 15 year peak is at 2. So honestly, over the last 15 years, State Bank of India has never crossed a price to book earnings of 2 times. So we are very, as you can see, I've marked it as yellow. So we didn't see this till 2008 9. I mean, the last time this happened was in 8 9 that we saw such valuations, and there are very high chances that this might just be the peaking of SBI, uh, both from a credit growth point of view. So banking stocks have done really well because they didn't have so much issue as far as deposits are concerned. So they had fairly access to very good deposits, and they sort of took market share away from private sector banks. So that if it now starts to reverse because the liquidity starts to coming in and deposit ratios, credit deposit ratios go up. So if some of those sectors which some of those issues which were crippling the private sector now starts to go away, then we might see a situation where the market share might go back to private sector banks because in terms of service quality, in terms of technology, in terms of serviceability, of course, private sector banks continue to be the best, right? And the public sector banks also had post-COVID, they also did a one-time write-off where, they just wrote off all the losses and suddenly the book started looking really good. And some of these historical issues were nowhere to be seen in the P&L and the balance sheet, and suddenly the numbers, the PAT numbers, looked very, very healthy. So for that was also the reason, but that was just, it was not a structural change, it was a cyclical sort of change that happened in that sector. And for those reasons, we believe that the run in the PSU sector is more cyclical than structural. And at some point of time, whenever this cycle peaks, one needs to be able to get out of this sector and, move back to your private sector banks, which have created long-term wealth over the last couple of decades. Right. So I'm not saying these are peaking right now. It's not a buy sell call, but it's very important for us to be tracking these sectors because any slowdown in banking and auto can lead to overall slowdown in the Nifty also. Right. So with that, I'll end the session, and happy to take our questions. The first question is already there. What about gold and silver prices? What will price point shall I wait to invest in gold and silver ETF? What's your views on physical silver and gold? So, my view of physical gold and silver is, of course, difficult to buy, difficult to sell, difficult to keep, right? If you are somebody who wants to marry their daughter and sons in the next 10, 15 years, you can buy physical gold today and convert into jewelry in 10, 15 years time because you will not have to go and buy gold, silver at that point of time at those prices, right? Which of course will be higher than what they are today. So I recommend buying physical gold and silver if you plan to convert that into jewelry anytime over the next 10, 15, 20 years because it's obviously going to get more and more expensive. So that is the only reason why I would recommend physical silver. Uh, but otherwise, there are, silver ETFs, gold ETFs, and there are times when silver and gold ETFs, uh, like the times we are right now. So, in January month, there was just too much retail participation, and retail investors, their bad luck is when once they enter the market starts correcting, right? So it's like a typical thing that happens every time. Once the retail investor gets excited about an asset class, suddenly you will see that that asset classes drops and and they are sort of stuck at the peak levels. But that being said, not this is not a permanent correction. Gold and silver are just consolidating at this point of time. We believe that $70 and below is a very good level to start accumulating gold silver because those are very, very high support levels. Sorry, for silver $70, for gold, we are of the view that $4,500 is a really, really good level. But we've seen gold being very resilient. Gold has typically resisted coming down below 5,000. But if we were to add, for our clients, this is not, of course, a investment advice. So, take your own call, talk to your investment advisor. But from our point of view, we'd be happy to add more gold at for below 4,500 and silver below 70,000 levels. Of course, when we say we'll be happy to add, it will be a very small addition of additional 5-10% of the entire portfolio. It's not going to be a big number because we've already been adding since 2024. Our first entry into silver was March 2024. So we've done a lot of position sizing. We continue to remain bullish. Our targets are crazy. So, but let's just say that for now, we are expecting gold to get to 6,000 and silver to get to 150 to $200, that sort of range. Not to say that this will be the peak, but we expect these levels to be certainly reached post market crash, post the correction in US markets. At that point of time, we will see gold silver peak. matlab, come back into rally, and then from there onwards continue a 1.5 year rally. So Indian banking sector, like I just said, you know, had a detailed 10-15 minute talk on it. Needs to be tracked. Of course, it continues to be in momentum, especially because of public sector banks. The large two, three public sector banks have been, uh, have been a great contributor to Bank Nifty going up. But one needs to be cautious because we might just be approaching peak price to book levels. So new entries, of course, not suggested. You might, time your exit as per the peaking of the price to book. But yeah, because credit growth has been very strong for some of these public sector banks versus, let's say, the private sector banks. And if that credit growth moves back to private sector, then we have an issue. And public sector banks, they actually wrote off all of their NPAs, but over the last 3.5, 4 years, as they go through the cycle and they see go through if let's say the crash happens and they go through a downturn, then it is very much possible because over the last 3-4 years they've invested in a lot of. If you look at their book, it's a lot of infra book, it's a lot of real estate book, that sort of book, and that book can very quickly convert into NPs. So it is very possible that the situation will can become very can change very in a very short period of time as far as PSU banks are concerned. Right. So be very cautious at these levels. Definitely not recommended to buy. Anyways, this is not a recommendation, but I'm just saying not good levels to enter right now. Um, but one can definitely look to exit over the next 2-3. We've already exited. So, but but somebody who is still holding, they might try to time it. Indian currency depreciated a lot in the last few years, and EPFO interest rates are not in favor even after compounding. So, madam, EPO was never an investment option. It is what you do because you have to do, right? Indian currency, as far as Indian currency is concerned, I think there'll be some improvement, especially with the EU and the US trade deal. I think we will see some because exports will start happening. So exports will start happening. So current account deficit numbers will gradually improve. The other pressure, however, is that with this war situation going on, oil imports continue to remain expensive, and that can counter the export thing. So I don't know, but things look difficult for the rupee right now. I think we are continuing to see FII selling also. So it's not that unless we see huge investments coming in to India, it's very difficult to see the currency significantly improve. I think after a new bottom, obviously there's some recovery. That doesn't mean that it's going to come back to 89, 85, 86, 87 levels. So not very bullish on the rupee right now. I think FY26 will rupee will continue to stay in stress with continued FII selling and import pressure, especially from oils and precious metals, because India continues to import both of these quantities in both of these sort of commodities in huge quantities. So that can put pressure on our current account. But obviously, some pressure has eased because of the trade deals. Do we still have to hold silver, gold, and Bharat bonds? Yes, of course, we are holding. We'll continue to hold. And if you think there is any other asset class that is very interesting, then do let us know. We'll be happy to evaluate any asset class for that matter, which is better than gold, silver, and at this point of time, very happy to evaluate and see if we can take some additional exposure there. In our view, nothing is protected. If खुदा ना खास्ता अगर मतलब यूएस मार्केट्स अगर करेक्ट होते हैं 30-40%, which every 3 years US markets correct by 20%. मतलब data suggests every 5 years they correct by 20 or 20-30% odd percent, and every 10 years they correct by 50 odd percent. So every 10 years there will be one event where US markets will correct by 50%. राइट, तो पिछले 3 साल में ऐसा कोई करेक्शन हुआ ही नहीं है यूएस मार्केट में. So there's a high chance that US markets can easily correct by 10, 15, 20%. Uh, Plus their debt market is already in stress. The situation with carry trade in Japan can escalate very, very quickly because it will just go out of control of Bank of Japan, and that can trigger at least 4 to 5 trillion of selling both in debt as well as equity in US markets, which can strain US markets significantly, both from debt and equities. Equities, of course, will lead to correction, but debt markets will typically then take your yields higher. If the yields go higher, then the housing market is in stress. If the housing market is in stress, then defaults start happening. We've already started getting news of commercial real estate being in stress in US. If you look up in Google, if you Google it, you will see a lot of news items about commercial real estate being in stress already, and a lot of developers already starting to default. So the situation is not good, and if the 10-year yield or the yield start going up in US for whatever reason, because of Japan's carry trade or because of some of the geopolitical situations where China, for example, decides to offload half of its, US Treasury holdings, that also can trigger. So a lot of stress, not a right time to go be bullish on, especially equity right now. No, so we are not looking to accumulate anything right now. Like I said, unless we see a 25-30% correction in US, and my view is it will not stop at 25-30% correction. It will at least be a 40-50% correction, because I mean, if you look at how the the US is positioned right now in terms of their debt to equity, in terms of how the Fed is positioned right now, they don't have a lot of leeway. For example, when the 2008 financial crisis happened, they had a debt of $1 trillion. And in 2000, when the crisis happened, they did quantitative easing. Of course, they put a lot of cash into the market. So the debt increased from one to two, uh, right? So they just doubled the debt during the 2008 financial crisis as part of their rescue efforts. From 2008, 9, 10, 11, 12, uh, they've been doing quantitative easing significantly, where they and of course in 2020 COVID also they did significant sort of pushing capital, pushing money into the system, where now the debt levels peaked at $9 trillion. And with the over the last 1.5 2 years, Fed has tried to reduce some of that debt, so they've been able to bring it to 7.5, right? Now, if for some reason, if a market crash happens, they don't have a lot of uh, leeway to push a lot of money into the system. Of course, they'll end up doing it, which will again end up leading to higher inflation numbers, and that obviously will lead to more de-dollarization and higher price of gold and silver, right? But they don't have a lot of leeway, and whatever they do will have serious negative consequences in terms of the economic impact. So it's not easier said than done. And the Fed cannot print its way out of the next crisis. It will be a much longer pain period. It will be a much sharper correction in equities. The debt markets themselves will go through a huge crisis situation. It's not going to be, the next crisis is not going to be something that the Fed will be able to manage so easily with just money, putting money into the system, because they have already reached 120% GDP, sorry, debt to GDP. They are already paying $2 trillion. How much more can you push debt into the system? How much more printing that you can do without sort of taking the inflation numbers high? So, very difficult task for the Fed, to be honest. Whoever is the next Fed chairman has to really, and for US economy to uh, sort of really find its way out of this debt trap. The only trap is the productivity solution, which is that AI has to significantly improve productivity, leading to GDP growth, and that will then sort of in some ways help to reduce the debt. But if, for example, this year, next year, whenever there is a crash, then the Fed doesn't have a lot of tools at its disposal to sort of manage or rescue people. Sorry, I just is so of course not Hang Seng B's long-term investment. So we are very bullish on China. I think this is the turn of that century where US will slowly lose its superpower status. China, of course, will become more dominant. Their manufacturing, their supply chain keeps them at the top of their game. Uh, so their economy is reviving. We did see some sort of price to earnings re-rating. I think the earning growth have to start kicking in. It's not a big position for us, honestly. Overall portfolio, also individual portfolio, also if you look, we've deployed a small capital there. It's in the profit, and if the earning growth pick, we will add more there. If it doesn't pick, then we will just let it be. So it's not like we are too concerned about that position. And if it doesn't do well, then we might exit also. It's not like we remain very flexible on that count. We are waiting to see some sort of earnings growth in the Chinese economy. Okay, moving on. Are the Indian bonds attractive enough for now, or it's just a strategy to buy? So I have been, we did a report also. I've been telling this to people. Don't think of bonds right now as just something where we are parking capital. Honestly, you will be surprised how in some situations bonds can end up doing double digit returns, right? And if you look at 2001, 2008 COVID, if you go back and just, for somebody to just go back, search on ChatGPT, how much did Bharat bond ETF generate in 2008 financial crisis or 2020 COVID situation, you will be surprised how some of these bonds have done. So I am not looking at bonds as just a means to park capital, right? We are expecting double digit returns from our investment in debt. Now, of course, it will not happen today, tomorrow. There is a trigger that will make that happen. The trigger is for both the RBI and the Fed to reduce rates significantly. They will do that once they start seeing some sort of stress. Once, of course, the US starts seeing some sort of stress in the economy, and they want to start liquidating, and they want to start quantitative easing again. So they'll start reducing rates. Once they start reducing rates, then your bond investments will suddenly go up, and those investments will start to give double digit returns. It is for those double digit returns that we are invested in debt. And yeah, so we intend to make serious money in all the positions that we are holding. So don't think of it just parking as as parking cash, right? These are places, all of these places, gold, silver, we've already seen significant returns, but debt also is somewhere where is an asset class where we are looking to make double-digit returns. Again, not a advice to buy or sell debt right now, but yes. So, Chinese government wanting to reduce exposure to U.S. treasuries is a problem for the U.S. market because that just pushes to, there's a lot of supply of US treasuries. So now it's for them to figure out who will end up buying that. And if they can't find a buyer, then of course the yields will go up. If the yields will go up, there is more stress for the housing sector, for example, right? Real estate loans will become even more expensive. So the housing sector will then start to react more uh, to these developments. So the bond market of US is like the pillar, and not just for the US economy, but the global economy because we all have exposure to US dollar. So China obviously uses some of these tactics to force US into doing what it was doing. For example, I think Trump wanted to capture some part of Greenland or the entire Greenland, and these Europeans finally decided to tell him that, look, we are holding almost a significant part of your treasuries. If you try to do this, we will sell your treasuries. And that would have created a huge financial problem. So one weak area for US, of course, is the debt market. And whoever wants to punish US or wants to teach them a lesson, they go back to using US treasuries as a means to sort of remind them that if you go beyond your boundaries, then we will start to sell your treasuries and your whole economy will go for a toss. I think, and that's how then Trump took a back seat, and now he's not talking about going after Greenland, right? He stopped saying those because the Europe had to really escalate to that level where they said, we continue to hold almost, I think, 10, $12 trillion of debt, US treasuries that we are holding. If tomorrow we end up selling even $1, $2 trillion out of that, then your whole economy will go for it, right? So again, China, of course, being an adversary, uses that strategy to teach US a lesson once in a while. What is the impact of it? So 10% brings everybody on the same level. Now. So relatively speaking, we don't have an advantage. At 18%, we had an advantage, relatively speaking. Now 10%, now of course, whoever is the lowest cost manufacturer will win the game. And we are not the lowest cost manufacturer. So I am not expecting. In fact, yesterday's trading also, uh, I will have to check Gift Nifty, but I don't think Gift Nifty was up significantly. Or even US markets were up significantly. Is the custom duty reduction by government enough for Indian customers to hold more physical goods? So I can't comment on the jewelry business. I can certainly say that uh, इंडियन लोगों को कस्टम ड्यूटी से कोई फर्क नहीं पड़ता, especially when it comes to gold and silver, right? We continue to accumulate. We will continue as an economy. We've accumulated and we will continue to accumulate. That's in our culture. One of the reasons why we call ourselves as wealth culture because some things which are just part of our DNA that doesn't just go away. So, custom duty, I'm not sure has been reduced for gold and silver. I think uh, that, in my view, remains same. So at least I did not come across any news specifically related to government reducing custom duties for gold and silver. In fact, they would want Indians to buy less gold and silver because it just adds to the current account deficit problem. So, So yeah, but whichever way, either physical or ETFs or whichever way, I think that trend is going to continue. More and more Indians will buy to the best of their capabilities. They will keep accumulating, and rightly so, because the dollar is sort of losing its status. The more the dollar loses its status, the more the gold and silver prices will keep going up. So yeah, I mean, pharma and auto ancillary especially are positioned well. I mean, we were exporting and will continue to export. I don't think 18% or 10%. Uh, from an absolute basis, of course, at their end, things get cheaper. So inflation, because it will be completely passed on to the consumer only, right? Uh, or for example, we were bearing 18% tariffs. A lot of it was not passed on to the consumer. Now, for us, it is good because it means higher margins for us. But yeah, I mean, फार्मा का तो पूरे वर्ल्ड में इंडिया का कोई सब्स्टिट्यूट ही नहीं है. There is no country like India which can manufacture pharma like we do. So whether it is 18%, 10%, 25%, 50%, I mean, we are the only guys who are doing it at the prices. So, so pharma will definitely benefit. Um, auto auto components, of course. I mean, even when we were doing 18%, we were doing well. Uh, or at 50% also, I think we were doing well. Because uh, US imports for auto have only grown, even with these tariffs and all, they have ended up buying more auto components, auto ancillaries globally. I'm saying so. Yeah, these two sectors will do well. BTC at current price, no. I mean, it's a recipe for disaster. Uh, and I told this in my last session also that whenever the market is about to crash, the most speculative asset will go down first. And uh, Bitcoins are a speculative asset. There is no way to value them. It is purely based on demand and supply. So Bitcoins, being a speculative asset, were of course expected to correct, and they have corrected, and the correction will continue as we head closer to a market crash. I wouldn't be surprised if Bitcoin goes back to 20, honestly. Again, not a buy sell recommendation. My personal views, I'm not a huge Bitcoin fan. I've never invested in Bitcoin. Again, disclaimer from my end. But my view is key, it being a speculative asset, whenever the demand for safe haven assets grows, a huge capital will move from risk assets basically, and Bitcoin remains a risk asset. It's not a currency, it's an asset class, and that to a very risky asset class. Uh, so in a risk off environment where people are not wanting to take risk, capital will move away from risky assets. It has already started moving away from Bitcoins or whatever coin. It has already, it will start moving away from equities also. And all of this capital will go back to gold silver. So to your point, whether gold silver will continue to go up, it will continue to go up because otherwise, if let's say, if for example, we try to imagine a situation where $120 was the sort of peak, and if you've studied the past peaks also, if you've studied the peak of, let's say, 1980s, if you've studied the peak of 2008 financial crisis, silver doesn't fall by just 20-25% and consolidate. It keeps falling. Silver is a very volatile asset class. If 120 was the peak, silver would already be at $30 because the correction is very aggressive. First three candles on the monthly chart are like 20, 20, 20. So you will see that in 3 months, whenever the real correction happens, that is what happened in 2008 as well as in 1980 when silver peaked at $50. the next 3 months were all three big red candles, right? Honestly, we've seen just one big red candle, and till date, we've seen only one big red candle, and silver has kept consolidating. It's not like silver is going down every day. By nature, it has to go down every day. If 120 was the peak, then it should go down every day. That is how it is, because if the big guys start selling, then silver has no bottom. It literally has no bottom. It can go all the way down to 20, $30. The reason why it's not going down, because the big guys are not selling. It's only the retail people who are trying to buy at $100, sell at $90, right? So they are the ones who are moving the market here, $5 up, $5 down. That's what is happening. The big guys continue to stay invested. I think I've covered this question before. Is it a good time to rebalance our portfolio with stocks and move out of silver and gold? Obviously not. That will be a huge blunder for us to sort of sell our gold, silver at this point of time and move to equity, especially when equity is rightly positioned for a crash. Why would I want to get back into equity, right? And we've covered this over the last 4 or 5 years. This is not a time to get into equity. Any fresh deployment in equity, I will put my neck out there and say this is a very, very bad time to. There is not a single reason why you should do that. Uh, because especially, and it's nothing to do with India, to be honest. So all the portfolio managers who are telling on primetime TV that Indian market has corrected, valuations have become reasonable, small and mid caps stocks are now in the buying zone. They are somehow ignoring what is happening globally to their own disadvantage. At some point of time, they will figure out. But I'll put it the other way. I will compare it to a time when we were in COVID, peak COVID situation. All majority businesses were shut down. Nobody was going to office, and the markets kept going up every day, right? So every day, Nifty 50 used to go up. People, everybody. So there was no earnings, to be honest. 2, 3 quarters, there was no earnings. And still the market just kept going up because there was too much liquidity in the system. So sometimes you have to go beyond the earnings to see how the liquidity situation is to be able to take a call on the markets, right? Obviously, valuation matters, growth matters, your earnings growth is very, very paramount. But if you are in a situation where you are expecting a huge liquidity pull out of from the system, and we've seen a huge liquidity pull out from the system, and if that liquidity pull out, now I might change my view. Again, I'm not wedded to a view. I might change my view if I start seeing significant capital come back to India. If let's say tomorrow we start seeing billions of dollars of capital coming back to India, then I'm open to change my view. I will do that. But unless I see liquidity coming back into Indian market, there is no reason why equities should do well. Especially since I pointed out specifically that the two big drivers of Indian equities, banking finance and sort of the auto sector, both are somewhere close to peaking out because they've already sort of done their mean reversion. They've gone from lower P levels to higher P levels. Now they are at close to high P levels. So the very, very high chance that the PE de-rating might happen, and that itself will lead to a correction. So these sectors, of course, have become expensive. Now, if you put the pressure of liquidity on it, the liquidity pull out, then some of these corrections can be very significant. So there's no reason for Nifty 50 to start and tell me which sector is doing well. Oil and gas has passed its peak phase. IT sector is not doing well. One of the biggest contributors of Nifty 50. Auto is slowing. Banking financial, in my view, is reaching the peak. So what is going to drive the Nifty up, right? If you can answer that question, if somebody can pull out some numbers and say, "Hey, look, this is where the growth will, and this is the contribution of this particular sector in Nifty 50, and hence Nifty 50 will go up from here." So I wouldn't, I mean, ये तो वो मैनिपुलेशन वाला जो है वो, of course, this has been proven that there are rich people out there who can manipulate the markets, right? So this manipulation thing, but it cannot happen for months and months. Manipulation doesn't happen for months and months. Manipulation happens for a day, a week. You can manipulate it for some day when a closing is happening, some expiry date or something like that. Unless we are in FNO, we shouldn't be worried about any sort of manipulation, right? We, especially being long-term investors, let's first get this manipulation thing out of our mind, because it's not easy to do. It's not. It requires billions and billions. There are people who have that kind of money to manipulate, but let me also tell you that nobody can manipulate the prices forever. The manipulation can happen for a day, an hour, a week, max a week, not more than that. Yeah. Okay. Thanks a lot for your time. It was a great session. I was sort of very happy to answer your questions. If there are any other questions, please reach out. Our contact numbers are already available on our website. Uh, Thank you. Thanks a lot for your time, and let's stay connected. And 2026 is going to be a difficult time, no doubt about it. One has to be very patient and have a strategy to be able to come out of this situation in the money. It's very easy to lose money in 2026. With that being said, thanks a lot, and hope you have a nice weekend. Thank you.